Welcome back, everyone. We've got another exciting episode of Chip Chat. This is going to be our third one this season, and so far the first two guests have been awesome. We just dropped our first episode actually yesterday to much fanfare. Haha. Today I am excited. I've got a really cool topic and an even cooler guest to introduce the audience to. It's Brandon Bruckman. Brandon is the co-founder with Insight Investment Advisors, LLC, and he's going to be sharing information with us today on a really hot topic known as DST, and that is not daylight savings time. So I'm going to turn it over to Brandon, let him introduce himself and give a little background, and then we'll jump into the topic. Thanks,
Chip,
Brandon.
thanks. Hey, Chip, how are you? Thanks so much for having me on. I really appreciate it. Sounds like I have a lot to live up to on the first two guests, so I'll try my best to be somewhat interesting. Yeah, it's Chip, as you mentioned. I'm Brandon Bruckman from Insight Investment Advisors, and we're rather unique, I think, as an investment advisor who focuses more on real estate and real estate related clients. And the folks that we help are really clients that have very specific needs. They're usually property owners that have held property for 20, 30, 40 years and would really like to maybe do something else with their day rather than managing these properties. And then we become really helpful. We're also helpful for clients that frankly have a lot of doors and want to consolidate and see the sort of the 20-80 rule. 80% of their problems are coming from 20% of their properties, or maybe like 90-10 that rule is. So we can help them too. So it's really for folks that are looking to sell that investment property. They want to defer tax. They don't want to manage the next property. They want passivity. And we help them do that through two different really vehicles. The first is sort of a mechanism. We help them do that through 1031 exchange. We can talk about that. And that's vanilla, nothing different with us, but this is 1031 exchange is a little bit different on the back end. So the replacement property becomes this weird thing that we think is interesting, but is oddly named a Delaware Statutory Trust. And that sends people's head into a frenzy of, well, what the heck are you talking about? So the Delaware Statutory Trust, or the DST, the simplest, easiest way to think about it is this is syndicated real estate. It's a big property or properties. You're going to own a portion of it. Someone else is going to manage and run it. They're going to send you a check. So it is truly a passive option. It is, since 2004, a revenue ruling in 2004 from the IRS, allowable as replacement property in a 1031 exchange. I think that's the piece that people don't know, that this option is available to them and is something that can work and fit for them given these situations and parameters we discussed. So Chip, I'll let you ask me some questions about it, because I can drone on for minutes. You'll fall asleep on the other end.
Yeah,
I want you to ask some
good.
questions.
And I will say, when you and I did sort of our precursor meeting, what I was so impressed with was your in-depth knowledge. I've been to a couple different events where this topic has come up, and it's interesting because the context. And I think I even shared with you a personal story. My father-in-law had a business with real estate, and when he was getting up there in age and he wanted to sell the real estate, he closed the business down. And what we were finding was, because it was a interesting building, commercial property, he was having trouble with the idea around the 1031, because he was like, well, what if I sell it and I'll go buy a building and lease it to Walgreens? I was like, well, it doesn't work quite that easily. He had a lot of misconceptions around what that next step in the landlord looked like. And sadly enough, I was not aware of DSTs. Now, this is many moons ago, so I'll use that as my cover. But this would have been a perfect opportunity, or a perfect solve for his specific situation. So let's dive a little bit down in it. Let's talk a little bit about the audience that you're typically working with on these DSTs. Who are you finding is seems to be the best fit? And I know that comes in all shapes and sizes, but just curious as to sort of some general takeaways that you see.
Yeah, our client archetype, we call it a client archetype, really is very similar. It is real estate property owners that are managing that property. They usually have between 10 to upwards of 100 plus doors. So they fall into that range where in some cases they are big enough to have and even own a property management company. So I think there's sort of steps to passivity. Maybe I'll talk about it this way. So I think maybe in your dad's case and other cases that we see is somebody who's very active and they go, well, I don't want to be as active anymore. How do I get passive? Well, the first step that we watch a lot of people do is they hire a property manager. You're like, well, that makes sense, right? The day-to-day stuff will have someone else do it and I'll pay them. What ends up happening there that and this can work very well. And we do see it work well in many cases. In other cases, what we find is that landlord ends up managing the property manager, right? And they're like, well, I'm still kind of spending the same amount of time that I was before, and I'm not getting the results that I want. And that's the part I think that really frustrates them. So, okay, what's my next step? All right, maybe I will sell. I've heard about these Walgreens and these other triple net lease properties. Let me go and do that, right? That's another step to passivity, and I have a bit of control there. I want that control. And so they'll go that route, and they'll start to own those. Quickly find out, and again, that can be very successful too. But what they quickly find out there is not passive. It is still active, right? Something breaks. You need to do a capital expenditure. You need to replace a tenant, right? These things become unpassive very fast. I don't think real estate's passive unless you have someone else doing all of
100%.
it, right? And that's what the Delaware Statutory Trust offers, is someone to do all of it. You absolutely cannot be involved in the management of these properties. You have no decision rights. Zero. For some people, that's really scary. They're like, ooh, I can't sell this when I want. No, you can't. I can't do property improvements. No, you can't. Someone else is going to do that for you. For others, that's exactly what they've been looking for through these other solutions. And they can't find it until they get into this sort of arrangement where it really is your job is to walk to the mailbox and pick up a check. That's your role. And that's it. And we call these sponsors that formulate these properties and these trusts. That's their job. Their job is to run it, have the property management, and it really intend to sell it. And the intention to sell it is up to them and when to do that. We have some parameters about when they would do that, but it is all the way passive. So that sort of promises kind of how they get there in that sort of aspect. I think I answered your question in a different way.
Yeah, no, that's good because I think the key piece that you sort of spelled out is the differentiation between active and passive. That I agree with you 100%. I mean, most people, and if you listen to really the whole trend of chip chats over the past couple of years, we talk about on the active side because that's traditionally where we're really focused. Is it's about having that team in place and how much energy and thought and effort really has to go to have a successful real estate investment business. It's not there's really is not an easy button in the active side. It's not. And anybody who tries to steer you in that direction, I would suggest you probably need to do a little bit more due diligence because they might not be giving you a full vision. But the DST, to your point, is really geared for those people that are ready to move out of active, want to go into passive, but still want that exposure in real estate. They want to be able to have some of the underlying economics that real estate offers, the tangible benefits that come out of it, and in a lot of cases, just the peace of mind and security. We'll talk about a little bit of just you know finding DST deals out there. I know the market's changing a lot over the last, say 12, 18 months. There's been a lot of with interest rates and just the commercial market itself has gotten, just it's moving. It's not, it's very fluid is what I would suggest. Not you can't sort of just all deals don't pencil out like they used to. Share with me sort of what your mindset is right now about finding viable DST deals and what role that you play in that process.
Yeah, I'll describe sort of the marketplace as it exists and kind of how we approach that. So the marketplace consists of at any one time there's about 40 different, again we call them sponsors who formulate these deals. There's 40 different sponsor companies out there that are offering DSTs to the general public. Of that, there's probably 40 to 50 deals that are active at any given time. My role and our role as a firm is to comb through every one of these sponsors, do our check on them, make sure that they're viable, and then do the check on those deals. And we'll do that. Every single DST that has hit the marketplace, I think we have pretty darn close. We've reviewed almost all of them, right? So that's our role. And to your point, Chip, there are deals in the space, and there always has been since we started looking at this, that to us don't pencil properly. and we have concerns about the viability of investor capital. We have concerns about the types of returns that they're going to make. It is concerning, and we'll throw those out. Those will hit
Yeah.
the chopping room floor,
So
and we'll
that
look at the
leads
deals that
to
make
sort
sense.
of my follow-up question in terms of the vetting process on the sponsorship side. It sounds like that is really some of the heavy lift that you do on behalf of the potential investor to make sure that they've been vetted and that the underlying asset or even the underlying management group has been properly vetted out to make sure that the performance metrics match up to what the risk could potentially look like. So, if you don't mind sharing with me some of the things that you look for on the sponsorship side that would differentiate maybe those deals that you're going to steer your clients into and maybe ones that you might shy away from.
Yep. DST on the sponsor side, DST experience is a preference, not a requirement. The preference there comes from the track record. We believe heavily in scorecard. If you can do it, show me you've done it, right? And so if you look inside the offering documents for any DST, you got to dig. Sometimes they're on page 200 or 300, but they're there. The full track record of every DST sponsor is in that document. It'll show you what's active. It'll show you what's been full cycle or closed, and it'll show you the return patterns. And it'll show you the deals that didn't go well. Because even from the largest sponsors, there are deals that did not go well. And it'll actually give you a description of why. It's very informative. So what we did is pull that out and display that for our clients across all sponsors where they have that track record so they can see it. And we visualize that display for folks. I'm like, oh, okay, this makes more sense. I mean, we visualize almost every deal we can get our hands on. It's historical return pattern in a one-page document. And so it's a helpful way to sort of like to look and evaluate sponsors in that way. When sponsors don't have experience in the DST space, and we think that's okay, because what we really want is experience in real estate. I really
Mhm.
want great operators. I want more operators, frankly, to come to this space and to look to raise money in this way. And we'll actively help those folks get into this market. We'll connect them with the right banks to get the right lending. We'll connect them with the right lawyers to get the right documents in place. We'll handhold them to come to market because we want them for our customers, right? And there we're really looking for experience in the real estate space. Again, show me that you've operated real estate. I have a preference that you've had investors before, because having investors is a different experience than just running the real estate. Running the real estate is the most important, but you'd be surprised at how important investor relations is, even when you're doing really well. The amount of communication that you need to do there and responsiveness is something for, I think, folks is a little foreign. We'll help coach and guide that, but our preference there is that you've had experience doing that and you have a system and a process to execute investor relations is really important. So that's really things we're looking for on the sponsor side. We'll do background checks on principals of those firms as well, to make sure we don't have any naughty folks that are participating there and kind of keep them out of the fray as well. But that's the big things that we're looking for. Just really great operators. That's what we're trying to find.
Okay. Yeah. No, that aligns and makes a lot of sense. Well, let's step back a little bit and maybe if you could walk the listener through sort of the process. So
Mm-hmm.
you touched on it at the very start, but give the listener sort of because if I'm contemplating, okay, what are my options? I've got a property, thinking about selling. I definitely don't want to, my cost basis is low. I don't want to be hit over the head with a tax bill. I'm 1031s on my radar. Give the audience sort of what those key benchmarks frame. There's definitely time sensitivity that we're well aware of within the 1031 space. But as it relates to DST, what do you suggest? Because obviously, I guess one of the things that I've seen a couple of times is somebody's running out of the runway on their 1031 and then they're hitting the proverbial panic button.
Yeah.
And sometimes I feel like that's almost too late to try to cobble it together because you're maybe going to make, as I always say, I'd rather pay tax on a good gain than avoid tax and make a really bad investment. Those math usually doesn't really align very well. So, would love your thoughts or feedback on that.
Yeah, I think it's a good point on the process. So I think as you kind of built yourself as a pretend client there, the way you described that was a absolute perfect way that we want to engage with people is I'm thinking about selling. I haven't sold yet. I'm thinking about selling. 1031's on my radar. I know I'm going to have a big tax bill. The things you said there are exactly what we're looking for. That's when we want to talk to somebody, right? And get them started to introduce this process is then. And I really want them to verify what is the gain going to be if you sell this building and have to pay the tax? Do you know what that number is and the impact on this current year tax? You'd be surprised at the people who don't know that. They make an
Yeah.
assumption. Don't
Yep.
do that. Please
Right.
talk to your CPA and understand that. Then we can get to work, right? You'll be, again, I was surprised at some of our clients that had other losses, I mean, in a different inside of their real estate business that they could have used against that capital gains, and then we have some more freedom with the money, right? Have that conversation. So we want folks to do that first. Then
Yep.
it's a perfect time for us to. Many haven't done 1031 exchange very often, so we'll help them. While we are not qualified intermediaries, nor can be, we will quarterback and walk them through the process, right? Because in our view, and this is the way I think, it's great when qualified intermediaries are offering good advice and help, but it's not their job,
Yeah.
right? Their job is to record a transaction and to move money, right?
Yep.
It's your job to do it right, right? You should have a guidance to your CPA. But again, what we find is CPAs don't spend a lot of time in this space either. We are looking at this every day. So we're good quarterbacks for that process. So we want to see folks before then. That's when we can start to walk them through these options and get them comfortable with what the heck a DST is, start to share the documentation with them. We start making some selections there about or narrowing the field of what they may want to be interested in. And we can kind of leave that for a second and then let you work on selling your property. Then we'll come back. All right, I've sold it. I have it with a qualified, I have the proceeds with a qualified intermediary. I've done all that correctly. Now I'm ready to invest. That investing process, if we've done the pre-homework, we can get that closed inside of a week. No problem. So we can go very fast, but we can go fast once we've done the work beforehand. Now, in the scenario so that's my ideal scenario.
Right.
That happens a lot. Here's a non-ideal scenario that you described. Hey, Brandon, it's day 42. I heard you on Chip's podcast. I need help with a replacement property. We can do that too. It depends on how fast that investor can get up to speed, because I can put things in an identification form tomorrow. No
Right.
problem. I can put them on today. We were talking right now. There's no reason that we can't send a few properties to your qualified intermediary. We can put them in an ID form. We can do our research and we can close fast. It's not an issue. We've saved many exchanges doing that as a backup of a fallback option. Totally
Mm-hmm.
fine. If you have other things that you're working on and you really, really don't want to pay the tax, I think we become a good option in that scenario of trying to save an exchange. It's not ideal. Ideally, I want you to make a decision to participate in this marketplace, not be forced into it, right? And I agree with you. If you can't get comfortable with this or it's going too fast, I would much rather have you pay the tax, right? Because the DST commitment that we're talking about has a life on it that could extend up to 10 years. It's a long time to feel like I shouldn't have done that. A whole decade of I shouldn't have done that isn't fun, right? I don't want you to do that. I'd rather have you pay the tax. But we can operate very quickly if folks need us to do that.
Yeah. No, and you touched on some really good points that I'd like to sort of reinforce with the listeners, because where we sit on the title side and the closing side, and we work closely with many QIs, and you're correct. The QI is there to serve a purpose, and it's a very defined purpose. It's essentially to move money in a very structured fashion that meets the IRS criteria. That's full stop. That's what they're there to do. So people that think that the QI is really going to be quarterbacking it, I'm going to be very honest. They're fairly misinformed. There are some QIs that maybe take a little bit more of a hand-holding approach.
Mm-hmm.
Typically their fee structure is going to look different than the guy that's just gonna, or the lady that's just going to move the money around for you. So I'd always say you get what you pay for in that. But technically, that's what they're there for. The title group is there to make sure that the deeds and everything gets moved around accordingly, and that we work with the QI to make sure the money goes to where it's supposed to, so it doesn't potentially get in the crosshairs of a taxable event. The one thing that you hit was the early education piece. I do think a lot of people are candidly not misinformed. They just don't know necessarily all the questions to ask when it comes to the process as it's related to a 1031. Yeah, they know, okay, I've got 45 days, I got 90 days, I've got these periods, But what they don't think about, one, know what my tax basis is before, like know starting out so that we can do the proper analysis, have the conversations with the family in a lot of cases around what is the goal, because a lot of this really is embedded in estate planning.
Mm-hmm.
So, and I'll let you comment on that in a second. But so those conversations before really build the strategy of where you're going to go. And what I see, the third thing I would say is, and I've actually promoted this recently on a couple, with the market in a weird spot. And what we're seeing is deals are falling apart more than I would like to see them. You're having deals go under contract,
Mm-hmm.
seller and buyer somehow get out of sorts, whether it be an inspection issue, an appraisal issue, a banking issue, whatever that may be. There's all sorts of issues that can come up, and they're on the back end of an exchange. I always suggest you might want to have a plan B in place. And that's where a DST can be perfect, because what it also does, right, wrong, or indifferent, and I'm not here to give any advice to how you strategize and negotiate, but it creates leverage potentially for you as the buyer of that next property. Because I have seen sellers in a 1031 where they're selling into somebody who's using that property as replacement. They know that because they have to. They've got to sign forms that says I'm participating in 1031 as a seller. There's an acknowledgement form they have to sign
Mm-hmm.
for disclosure purposes. They sometimes use that as a lever, like, hey
Yeah.
man, I'm not bending on that. You fix the whatever it is. That wasn't in the contract. And so I would suggest it's good sometimes to have a backup plan. You should always have a backup plan, but to have that, because then your walk away challenges are maybe lower. But once again, I agree with you. It's not your primary strategy. Never should be to have a bunch of moving parts, but it's good to know all your options. So I'll let you maybe talk a little bit about the estate side, because there's usually maybe more people involved in these conversations than just a would be seller and a soon to be buyer.
Let me comment on your last point first. I thought it was really interesting. I haven't heard that before, but it pains me to hear in our real estate space sellers or brokers or anyone involved in the space say things like, "Well, this is good for a 1031 exchange buyer." What? No, well, time out. Stop.
I have heard that, man. I really
That, let
have.
me allow me to translate. That means
Yeah,
you're going to get not a great deal, or
yeah, yeah,
you're going
exactly.
to get no. Why? Why should you have to do that? So it's interesting. We've definitely used. We've had our DSTs or the DSTs that we review part of a backup plan, but never really have I heard folks using it as a leverage point, and they really should. Yeah, I can walk away from this great deal for Mr. 1031 buyer. I'll walk away from it because I have other options. And there's no harm or no foul, especially when we use something as simple. The IRS is giving you the ability to have a backup plan. They're giving you the 3 property rule in the 1031 exchange. Why not use it?
Yeah,
No harm in putting a couple DSTs on there. You don't have to pay me a dime to do it. Easy. I'll help you do that. Simple. If you use us, great. I might you have to pay me, but if you don't use us, that's fine. But at least you've gained some leverage and you've saved the exchange at the very least. So I think that's a really good point that folks are missing the ability to do that. Really simple thing to do on the
yeah.
estate planning side.
Personality is helpful.
100%. On the estate planning side, you're right. When clients are making the decision to come to our space, and I hate to use this terminology because they hate it, they're making a decision to retire, right? And that fundamentally changes not only what they do day to day, it's going to change how they interact with their spouse. It's going to change how their heirs will interact with the estate and their wealth on a go forward basis. It should make all those things easier, right? Because the DST, just like any other property that they would own, will get stepped up basis if we keep that law in place. Will get stepped up basis upon their passing, right?
Mhm.
And so it should be part of an estate plan. There's a lot of folks that come to us as clients that don't have an estate plan. They don't have a trust. They come with properties in their own name in many cases. We say, hey, here's a good time to start to think about this transition, right? We should think about going through that estate planning process. It's a good spot. It's a good entry spot to start to think about that is right now. And that's an easy thing to do. There's absolutely no reason that they can't sell their property, do an exchange, invest in DST in their own name. If they have the properties in their own name, there's no reason we can't go back after they've formed a revocable trust and retitle those DSTs. Very simple process to do. So no reason we can't do that. It's something they absolutely want to think about. And it's really driven too
Really
by,
good.
and we see this from our real estate clients. We also see this from farmers who are a growing segment of our client base as well. It's really when your heirs, they may not want to do this business anymore. Hate to say that. It pains. I know my kids don't want to do my business. I can tell you that for sure. But the kids may not want to run the property when you die. So I think a lot of folks' mind is, well, I'm going to keep swapping properties until swap till you drop is terminology that we've heard before. And then my kids will worry about it. They may not want to do that. They may not want to manage it. And they may not want to worry about, especially after you've just passed, worry about the transition of selling that property. So you can take a lot of that burden off the table for your heirs by going this route. When you pass here, the basis is stepped up. The DST continues its life, but it's passive. They keep getting checks. There's nothing for them to worry about from that perspective. So in that way, I think it's a pretty darn good estate planning tool, especially if your heirs aren't considering continuing in this space or this business.
Yeah, no, I think it's a powerful tool because also you can create some predictability for your for the potential heirs. It's a lot more. We have seen where, candidly, in the title space, you get these estates, and they've got a lot of real property in them, and puts a lot of pressure on the executor. Who's typically one of the, whether they're the oldest sibling, middle, whomever, the appointed one, the golden child, whatever you want to call it. And you can just see the stress and strain that goes through that property disposition piece,
Mm-hmm.
because everybody has their own views around value, and they typically have potentially their own views around what they want to do. So this is a defined pathway where, once again, you've got real estate professionals, pulling all the levers, and it gives the heirs an opportunity to really just focus on dealing with whatever other household matters that they need to deal with. So, a
What's
really,
The George Clooney Hawaii movie, Descendants?
yeah,
He's the exeter of that estate. Go watch that. That's an extreme example, mind
yeah,
you,
yeah,
but I mean,
yeah.
yeah, there's over. That's what popped in my head when you're describing that.
That's funny. That's a
There's
good one, man.
overtones there of like that could be
Always like a
you.
good movie reference on the podcast. You pulled that one out. Well, before we wrap up, this has been awesome. Is there anything else that I haven't engaged or asked you about that you'd like to share with the audience? And then the final thing is, I want to make sure they have your contact information so they can engage. As you said, just call and have a preliminary discussion. I mean, 10 minutes, and you can probably figure out, is this anything worth pursuing, or am it something I need to revisit later on? But really quick, anything that I've missed or haven't asked you about that you think would be helpful to the listening audience?
No, I think this has been really good, and you said it. You said it right. Yeah. Just call and reach out. I can probably tell you in 5 seconds. Yeah, or give me five. I'm gonna ask 5 questions. I'll tell you if this makes sense for you or not. I might steer you in a different direction, frankly, after I hear some of those responses. But I think the easiest place to sort of learn more and find us is obviously the site investwithinsight.com is where you can find that. We do run a podcast as well, The Retiring Real Estate Investor, where we go pretty deep. I've done 4 to 5 episodes just on the intricacies of DST with my partner Josh Wright, and we'll tear it all apart bit by bit for folks so they can really understand and dig in as deep as they want to on that. So I think those are two good resources. There's all kinds of education out on our site. And then, yeah, please listen to the pod if you want to learn more. It's a great place too.
Yeah, no, this has been awesome. Like I said, when we had our pre-call, your knowledge came through very quickly. And what I've tried to do to the best of our ability is to deliver content that is, one, meaningful, but that, two, is actually real. So we've in the past, the fake it till you make it on a DST deal. I don't want that. I want somebody who is crossed their T's, dotted every I. Has you've probably seen some deals not go great. That's you learn from those, and you've seen some sponsors that didn't necessarily perform like you would like to see them perform. So you learn from that. So I could just pick up right away that you had a very in-depth knowledge of the space, and for our listeners, we want them to reach out. And we always talk about team, put a team together of knowledgeable real estate professionals that you can trust. Hopefully you like them, that helps. But if you can trust them, and then you're going to have the best outcome.
I'd rather have you trust me than like me, but you can like me too. I'll take it.
Yeah.
I
Well,
want to
good,
know.
man. Thank you so much, Brandon. I really appreciate your time and the information. And I encourage the listeners to reach out to you directly to learn more about Insight investment and the DST space. It's obviously a very powerful tool. And with the population, we all know the demographics. I think it's going to become more and more prevalent in the years to come. So thanks again. And we're signing off for Chip Chat. Hopefully you enjoyed the episode and look forward to talking to you soon.